staying on the limitations for a minute, that you made a very powerful statement before about public equity markets. And the view, if I understood correctly, was that it is impossible to create social impact in public markets. Is that what you meant?
I may have overstated it just a little.
Okay.
But I'm saying, that is, if I came at this on a factor-based asset pricing model, and it turns out that there was really a very, very large chunk of capital market investors who valued that, that is, who treated returns and liquidity and care about, and will, in effect, take a concessionary return, then in that certain sense, and I not only haven't tried, but lack the skills to begin to model what the distribution has to be to do that, then in that circumstance, you can imagine there being an impact. But short of that, which I view as almost a corner solution, I don't understand. You're trading one shareholder for another shareholder. You'll end up with investment clienteles like tax clienteles, and whatever particular investors care about will just get arbitraged away. I know one example of how you could do it, and it involves a mutual fund I'm involved with, but it's a peculiar story. The family that founded it was enormously successful in its early years in very undisciplined management, but they made a lot of money. And both the husband and the wife who were involved, both developed cancer and both survived. And they took about $3.5 or $4 billion and in the stock of the asset manager, and created an absolutely first-rate cancer research institute in Kansas City. The Cancer Research Institute has a roughly 45% of the profits of the advisor. If you invest in this fund, what you can say with some confidence is that whatever the management fee is, 40% of that profit is going to go to cancer research. It's got nothing to do with investment. It reflects the coincidence of some rich people who turned it kind of into a foundation. But I can measure this. It's the only circumstance that I can think of where you can really genuinely directly measure it, and then
Perfect. Well, thanks so much, Ron. Carol, over to you in terms of the limitations. Do you see any limitations on the social impact that investors can have? And if so, how should those be communicated to align expectations between asset owners and the managers who are making representations about social benefit?
Okay. Well, first, if it would be okay, I'd just like to respond to the point about index investors, the BlackRocks, the Vanguards, and the State Streets of the world, collectively the top three biggest index owners, and given the fact that the market, the equity investment market is really shifting towards index investment, they own a very significant percentage of the overall market. So, how do you define an index investor? If you own a large index, you essentially own the entire market. What does that mean? It means that if one company in your investment portfolio is generating negative externalities, it's going to negatively impact another company in your portfolio. Okay, so you've got essentially risk exposure to the entire market and every ESG issue. What else defines an index investor? You're not an active investor in a sense that you're constrained. You have to replicate that index. You don't have the ability to make buy and sell decisions based on your perceived value of the individual security. You have to replicate the index. So there has been a big shift, it's, fairly recently, within the past couple of years, where the index investors have decided, okay, what should our engagement activities be? And to Ron's point about BlackRock hiring, very substantially more people on their governance and engagement team. And why might they be doing that? Why might they be thinking about that from a strategic standpoint? Well, they've decided, we're constrained in terms of our ability to make investment choices in the context of these index portfolios, but we've decided that we're still responsible where we can for managing the risk associated with the investments. We're responsible for our clients to managing the risk to the extent that we're able to do that. They're in a unique situation since they own such a very substantial portion of every outstanding company that they have a lot of leverage. They have the ability to vote their proxies on these ESG issues, and if they want to, they can have substantial leverage and have substantial impact encouraging companies to make positive changes in these areas. So steward can be a confusing term. Again, I would go back to the fact that doing this does create this natural alignment with the broader objectives of society, but they're very squarely doing this from a risk management perspective. They're doing this in line with their ability to generate the best possible risk-adjusted returns for their clients in the context of how they're able to do that in their index portfolios. I'd come up with a similar example from the asset owner perspective. If you're one of the world's largest public pension funds, CalPERS, CalSTRS, GPIF in Japan, some of the largest investors who, again, essentially own the entire market, you're facing the same situation, where if one company in your portfolio is generating these negative externalities that they might not be paying for in their business model, it's going to be negatively impacting something else in your portfolio. And at the macro level as well, these issues have the ability not only to affect individual companies, individual securities, but they can in fact affect the stability of the overall market. So of course, when you make investment analysis, you look at the macro and you look at the micro level risk associated with an investment. So these are really the reasons why the index investors are pursuing these strategies and why the what we call the universal owners, it makes financial sense for them to be doing this. And to your question, the question about what types of risks and limitations there are, well, there are things to consider. If you want to undertake a responsible investment strategy, there are resource requirements, whether those be investments that you need to make to get additional data, to be incorporating a broader set of investment factors into your investment analysis, allocating resources, whether that be hiring 100 people on the governance team or hiring some people that specifically focus on ESG, or even educating your portfolio managers and investment analysts on ESG issues. There's a cost associated with that. There's a resource demand. So that needs to be acknowledged. Yes, I would say that's a major consideration.
Great. Now, Imran, I know I sense you want to jump in there. If I could just stay with Carol for a couple more minutes on this.
Because Carol knows things. And I'm, so this is important.
So Carol, we're going to open up soon for comments and questions. I'm sure our attendees have a lot to say on these topics. In terms of advice to different stakeholders. So the theme today is about public funds. So starting with public funds, what would you advise them to think about when they look at ESG integration? Similarly to managers who are, of course, signatories. And also to all of us as individuals or private investors, what words of advice do you have when it comes to this question?
Yeah, start somewhere. We have investors coming to us at the PRI at many different stages of their ESG integration journey. In terms of what kind of support that we provide them. We put out publications, 5 or 6 major publications per year looking at ESG integration, the how-to of ESG integration across different asset classes, investment categories, as well as looking at the individual ESG issues, educating investors on the materiality of those ESG issues and helping them understand how they can incorporate those issues into their engagement activities. So I would say certainly you can sign up to the PRI. I wouldn't advise against that. But also, utilize the resources that are out there, whether it's PRI or other organizations like US SIF series. There are many organizations operating in this space. We collaborate pretty extensively as well. Utilize the resources that are out there and available to you. Talk to your peers. Certainly one of the biggest points of advantage to the PRI, aside from the resources that we provide in terms of content, events, and people, are the fact that you get to engage with this global signatory base to not only understand kind of what the current thinking is on these issues globally, share best practices with your peers, et cetera, but also you have the ability, to the extent that you want to influence the market, to kind of contribute your voice to the direction of development on ESG issues. So I would say whether that be through the PRI, whether that be through your own other channels, talk to your peers, find out what they're doing, find out what works for them, find out what doesn't work for them. Yeah.
Lovely. Thank you. Ron, same question to you, which would be advice to stakeholders, public, so managers of public funds.
I want to separate out something that we've spoken in a phone call earlier, which is what do you do? How carefully are you on concessionary, non-consensual when you're a pension fund? And I'm really straightforward. If you're a private pension fund governed by ERISA, you don't have any choice. Mm-hmm. But CalPERS, the large public funds, aren't governed by ERISA. CalPERS has a history of making unusual investments which are presented as ESG investments that have been disasters. The impact, the social impact of CalPERS not performing well are bankrupt cities in California, because it generates, and it also creates, how shall I put it, lying by public institutions when they identify what return they're expecting in the future, which frankly, if all of us could get that, we'd jump at it in a second. But the reason they're doing it, and they know they're not telling the truth, is because if they lower the expected return, it increases the amount that every city in California pays into their pension fund and diverts assets from the pension fund to something else. So the public funds, as a matter of principle, shouldn't be any different than private funds. Now, I made a little bit, I took BlackRock a little lightly, and I don't mean to, because they actually they've been doing some things which seem to me exactly what you would, if you were an index investor, what you would do in order to improve ESG performance across the whole portfolio. 2 years ago was the first time that BlackRock voted against a management's position on an ESG issue. It was accidental petroleum. The structure of the proxy proposal made by the environmentalists was very carefully done. What they wanted the company to commit to was, on an annual basis, a careful evaluation of ESG, they'd say ESG, of ES issues on their business strategy going forward. Now that strikes me is exactly what you do if you were an index fund, because what you would like the more informationally efficient the market, the more you're protecting investors in an index fund against and BlackRock has been very good about that. They're quite clear that when it's an issue of information, they're willing to force the company to spend all the money the company says they're going to have to spend if they do this, because it provides a payoff to their investors. They end up with prices that reflect these kinds of risks, which does affect an index fund. So, on the other hand, I don't know why that takes 100 people to do, and so I'm still wondering what it is that the 100 people do.
A lot of ESG issues.
But in terms of disclosure requirements, you're all for that.
What I'm for is that sustainable accounting, generating information that an asset manager, a portfolio manager, can deal with in order to assess these risks. Market efficiency isn't free. Market information isn't free. But if you're in that, which is basically just collectivizing the information search, and then it becomes a sensible thing for a steward who has a large enough portfolio for all sorts of reasons, they can't engage with everybody. But that struck me from BlackRock's perspective, though I'm not sure they presented it that way, as a really, sensible, a really sensible way of
Yeah.
concerned about that.
In fact, I would say, specifically looking at those shareholder resolutions happening around encouraging or insisting that companies report to investors on their risk exposure to climate change risk specifically, which is what the Occidental Petroleum proposal was about. Yeah, for the first time ever, now the biggest investors in the world, the largest stakeholders or ownership stakeholders in these companies are getting on board, and for the first time ever really supporting voting against management in many of these cases. And that really has been the differentiating factor that's allowed there to be enough critical mass to force these companies now to listen, and in the case of Occidental, and then subsequently the case with ExxonMobil, where they've now reported on their climate change risk exposure. I mean, I will say that the reports that they came out with were less than satisfactory for a lot of investors. There's still a tremendous amount that needs to be done more for there to be really adequate disclosure for companies so that investors can take that information and use it in a useful way in their investment modeling. But it's been tremendously important. I'll also say, just kind of commenting in terms of the public funds, it's true they're not regulated by ERISA as corporate pension funds would be, but ERISA is a guideline that they look towards, and it's something that's really widely followed. So even though they might not specifically be regulated by ERISA, it is something they look to as a benchmark, and it's very important for the public funds, in terms of looking at the direction, in addition to the direction that they're given by the Department of Labor. And I'll just make the point, in the case, for example, with CalPERS, there was an instance where they looked at the portfolio returns as a result of not investing in, I believe it was cigarette companies. So I'll make the point, and you hear this all the time in investments, if an institutional investor or an individual investor talks to their financial advisor, or even on television when you see a commercial for a financial advisor, they'll always say that past performance does not guarantee future results. So one thing that happens a lot in the finance sector is that returns, a story can be told, and you can put together the financials over a certain time period, looking at a specific subsector, really to tell the story that you want to tell. And so it can be easy to kind of manipulate results, looking at a specific time period, et cetera, to make results look bad. That's not to say, with the example of cigarette companies, for example, maybe over the past several years, they've benefited, for example, through expansion in the emerging markets, selling cigarettes to children. This has led to profits. But who's to say that over the next 10 years that might be different, that in those countries where they're, Indonesia and the like, where they're selling these cigarettes very profitable, that there won't be an increasing level of social awareness that makes these companies lose their social right to operate. It leads to decreased demand, et cetera. So again, just point to the fact that past performance does not guarantee future results. And I think that that's very important in the context of fossil fuel investments as well, when you're looking at concepts like stranded asset theory. Just because energy companies over a certain time period may or may not have done well, that doesn't guarantee that in the future other alternative energy sources will become cheaper, become more viable, make the business models of the fossil fuel producers less viable over the long term, and make them less profitable. So just pointing that out there.
Thank you, Carol. So we have 20 more minutes, and I definitely want to open it. I want to leave 1 minute each for you for closing remarks at the very end, but now want to take questions and comments from the floor. So first, if I may ask you if you could raise your hands if you've got a comment. And we can see how many we have. So one here. Are there others? 2, 3. So if you can hold yours for now. Let's start with 1, 2, and then 3 over here in the front row. So ma'am, if you could start with yours, please.
Sure. So my question is sort of around measurement. So if you are looking at a particular portfolio company or a particular portfolio manager, and you're trying to measure the impact of certain initiatives that you're doing on an ESG kind of basis. On the environmental side, it strikes me that there are some operational efficiencies and things that maybe are a little bit easier to quantify in dollars. On the social side, a lot of the benefit seems to come from avoiding negative consequences. So maybe you're ramping up your compliance function or your legal function or your HR function to avoid problems. And I just wonder, how do you think about how companies can measure whether their social initiatives are having an impact on, returns, basically?
Lovely. Let's hear the three questions and then respond collectively. So, Sert, your question.
My question is very related because he kept talking about measurement being a problem, which I agree with. But I also know that there are these tools and frameworks being developed, like carbon pricing or like the Sustainability Accounting Standards Board that's designing quantitative metrics for ESG. And again, I agree that lack of measurability is still a problem. So what is the disconnect between these tools and frameworks being developed versus what's actually happening in the market?
Lovely. And we'll hear from you in the front row.
Hey, my name is Simon. First of all, thank you three for coming to speak with all of us. And I just couldn't help but notice Carol's button for SDGs. I love it. I'm on the board for UNA and do volunteer work for the UN, so thank you for that. And speaking of the UN and kind of global things in general.
Can you a little louder, please?
Sure. You mentioned, I believe, a fund or something from Japan. If you're allowed to speak about this, I'd be interested to hear if you could speak about what regions around the world are kind of the easiest to work with in your network and which ones are the most difficult.
Great. So let's start with Carol then, and then hear Ron on the three questions.
Yep. So talking about your question, I would still again just make that distinction between ESG being utilized as kind of a risk management framework as opposed to the metrics. And there are a lot of frameworks that are being put in place, both in terms of determining what kind of data should be reported by companies, such as the SASB, Sustainable Accounting Standards Board framework, which is excellent. We work together with them quite a bit. Referring to this PIN, the Sustainable Development Goals, particularly since the PRI originated with Kofi Annan at the UN, the Sustainable Development Goals themselves are being used as a useful framework as you try to solve that problem. How do we measure impact? How do we kind of generate scale on these investments by coming up with a useful methodology to measure the impact from investments? And so the Sustainable Development Goals themselves have emerged as a useful framework to kind of map the impact of investments in companies on a host of issues that collectively contribute to the general concept of alleviating poverty. I'm sorry, the third question. Oh, GPIF. Yeah, absolutely. So GPIF, actually the world's largest public fund in Japan. Hiro Matsuno, the CIO, is actually on the PRI's board of directors. And the work that he's done within that fund and GPIF as a leader has really, I would say, moved the market forward, not only within Asia, within Japan, where you've seen other investors kind of following suit on issues like engagement, but they've had a much broader impact within the overall market, just given the size of their investment portfolio. They're not only influencing Asia, but they're really influencing the world globally. And I'd say that their CIO in particular has really been a very vocal public leader speaking around the world on these issues and helping investors understand that this is something that not only does it create that alignment with the broader objectives of society, but it's something that it has the ability to support your portfolio performance. In terms of other regions, the PRI started in London. Some of the initial founding signatories that were the most active and most actively engaged, perhaps not surprisingly, were in places like Northern Europe, the Nordic region, the Benelux region. And these investors, I would say, continue to kind of be on the cutting edge in terms of how to do this, how to integrate it into investment practices, and how to align it with social objectives as well.
Lovely. One?
The strategy side and the measurement side. Much more development of data. I want to talk for just a second about that. And in this, and I want to talk about two things: the jointness of both costs and revenues, on the one hand, and how you go about thinking about what it is you want to disclose through accounting standards. And basically, on both of them, in most circumstances, when there's jointness, there isn't any way to allocate them. It kind of depends why you're asking. The same thing with, to the extent that sustainable accounting standards are mimicking international accounting standards or the U.S. My own view is that I don't want any principles. What I want is raw data, because every investor is going to have a different way of looking at the data, and to the extent that the numbers that are published reflect a set of assumptions about costs more generally, just disclose the numbers and let everybody mix and match them as it is responsive to their own concern. We're a long way from that. The more, the better. I'd rather have more information. I'd rather have more information from less. And you can begin to think that as you begin creating lots of detailed data, that the potential for using big data approaches to be able to understand this stuff better than we're doing, because we're still getting lumpy data, and which doesn't lend itself to it. There's a future that may solve a good deal of our problems. But I mean, on the company strategy side, there isn't any way to quantify the jointness, but that's management. That is, it's the exercise of judgment about knowing your market, knowing how you manufacture things, what your inputs are like, and you're making assumptions about jointness all the time, even if you can't formally be able to divide them. So more data and management that's self-conscious about it will do a better job with this, just like we'll do a better job with everything else if we know more and we're more deep and we're more careful about it.
Lovely. So let's take 3 more. So I saw one over there. So we'll take 1, 2, 3, please, if we could. So we'll start with the gentleman in the scarf, then the lady here, and you, sir, in the blue shirt.
Well, I have 2 questions for Carol. I was just trying to understand the working of the PRI. Tax evasion is becoming like a big menace these days, and I was recently reading a report of Oxfam how big pharma companies are evading taxes and how it has a negative impact in developing countries. So you talked about negative externalities. Do you consider tax evasion or avoidance as a negative externality? And my second question is, how do you monitor the compliance of the signatories? Is it completely based on good faith, or there is some monitoring mechanism also?
Thank you. Miss?
Yeah, very similar to what he said. My name is Charvi, and my question is about how do you bring about transparency in what people are reporting? Because a lot of companies, be it asset managers or even large corporations, are jumping on an ESG bandwagon because it's just the cool thing to be. But so are they really doing it? Are they whitewashing, greenwashing, or are they really having ESG in their processes and systems? How do we check that, and how do you manage that?
Thank you. The gentleman in the blue shirt.
So I think, Ron, in terms of my head, your argument appeals to me. In terms of my heart, I think Carol wins the day.
I hope I win both sides.
I have to say, I wonder if there's not something in between on this. So basically you're saying there's kind of an equilibrium out there, and you can chop and dice these things as much as you want, but at the end of the day, things still pretty much stay the same, right? You're saying correctly, Ron, on this. But, I kind of wonder, whether you did the analysis fully, because the art people, I think in this room and elsewhere, actually do care in their overall assessment of their investments about some of the externalities which Carol referred to, but it's not just how firms view the externalities, it's also how the consumer, the investor, actually sees it as well. And there are consumption-based theories of investment, as you know, and in that case, I should certainly put some of my money into supporting firms which makes the probabilities of having a healthy and long life greater than otherwise. Now, that seems to be maybe trivial, but then I kind of wonder, there's a market for that. If you believe in financial innovation, and I know you don't believe in financial innovation, you come up with a structured financing thing where you got people who, are willing to put to kind of bear the first impact risk, it's not social impact, first impact risk issues. And then the rest of the market takes a look at it and says, oh, well, since they're willing to get a lower return, you know, even while taking higher risk, which is kind of a bizarre thing to do, but they're willing to do that. Well, then they have kind of made it more attractive for me to invest in this particular firm, right? And so you do get an outcome where you kind of perhaps increase the pie of the people willing, who are financial terms, financial interested alone to invest in those particular companies. And you can separate these things out, so you don't have to mix everything up like the way you're doing. You got the social investor getting some security, and you got the financial person getting some security, and everyone's happy at the end of the day. They got exactly what they want. So what's wrong with that?
So, yeah, let's start with Ron.
I'm just going to come back to this because it's kind of fun. There's nothing wrong. So one, of course, people believe in innovation, because they may not believe in linear innovation. They may believe in financial markets in punctuated innovation, because that would explain the crash phenomenon. But what you're describing in sort of in popular terms is you're describing factor investment, and I don't see any reason in the world why I might not personally be perfectly happy to take my return, some of it in financial terms and some of it because I care about the world my grandchildren are going to live in. Perfect, and it's perfectly sensible. Whether it has an impact on the stock price across most range, my belief is that it won't until you end up with a significant enough group of investors who will no longer view good environmental, good social things as consumption. They will view it as part of the return they get because they care about it. In that circumstance, of course, it'll have an impact, and it'll be a positive thing. I just think we're a long way from the setting in which if what I do is I go to people and I say, look, here's the return you can expect. What you're going to see is that it's 30 basis points lower than what competitive funds would do. Here's what you're getting for the 30 basis points. I can tell you what we do differently, and I'm going to give you numbers. I think I could sell that fund. I'd have to sell it at the kind of individual level. I couldn't sell it to an ERISA. I mean, I'd have to worry my way around the regulation. But I think that's a saleable fund. And if I suddenly start doing that and I gather enough assets across the economy, then yes, it'll affect the stock price.
Yeah, and I would say if I could just
Please.
respond with respect to ESG integration. So you're a portfolio manager. You're assessing whether or not to make an investment. You have an expected rate of return based on your valuation of the business model, et cetera. And then I say to you, okay, but have you appropriately considered the following ESG issue? And the PM says, oh, I didn't really think about that. Now I'm going to incorporate this, think about this additional risk and how it impacts the financial prospects of that company and how that might impact the valuation. And in some cases, the answer might be, okay, now I've incorporated, maybe you've adjusted the discount rate you're using, you've adjusted the multiple you're using depending on your valuation model, and you might decide, yes, I'm being compensated for that risk in my expected return, in which case you're going to continue to hold that investment, or you're going to make that investment decision, or maybe the answer is no, and you'll not make that investment. But I guess the point being is that ESG is just a way to incorporate that additional, more comprehensive risk assessment in your investment modeling. And now just to respond to some of the questions that have been asked, I think there was a question about tax avoidance. Tax avoidance is an issue that's being looked at under the realm of governance, generally speaking, and under the umbrella of corruption. whether tax avoidance is something that generates a negative externality that can impact the market. So that's absolutely something that I think is relevant. There's a lot of attention being paid at the PRI and other places around tax avoidance. I'm sorry, what was the second part of your question, Nick?
Second part related to, is there a compliance mechanism whereby you are monitoring your signatories?
Right, and that tied to your question as well. So all of our signatories on an annual basis goes through a PRI reporting process where between January and March of each year, they go online and answer a pretty substantial set of questions about exactly what they're doing to integrate ESG across their portfolio. There are two outputs of that annual reporting. One is private and one is public. And interestingly, even the private report is something that an asset owner, so for example, a public fund, an endowment, or a foundation that might be awarding a mandate to an investment manager might make a request to see their full private reporting in addition to the public reporting that's available. And that really gives them the ability to see beyond kind of the glossy marketing materials and kind of just that stamp that you're a PRI signatory and look into a much greater degree of detail as to what they're actually doing in their ESG integration efforts. And so we have something called a data portal where our signatories can go in and really automates that process of making those requests to see that reporting. And we're really educating our asset owners, the allocators of capital, in the selection, appointment, and monitoring process and how to use those reports, how to understand those reports, and how to integrate that in your investment decision making. So that really creates a mechanism of accountability and a way for the consumers, the asset owners, to actually see beyond the statements of some managers who say that they're integrating ESG to see whether they really are in fact doing that effectively.
Wonderful. Ron, you wanted to comment on externalities.
I wanted to flag something because we talk about externalities as if we really know what we're talking about. And across some dimensions, if I'm dumping, if I'm dumping the sort of stuff GE was dumping into the Hudson River, I can sort of count that. But I just want to suggest it's not any easier to do sophisticated strategy with respect to externalities as it is anything else. And in a world of big data, I'm just going to provide an anecdote. A good friend of mine who's just a world-class microeconomist got hired by McDonald's. And what he's asked to do is, look, we can put hamburgers in cardboard containers or we can put them in styrofoam containers. We don't much care. Tell us which one is going to have the least environmental impact. And I mean, this fellow is unbelievably careful. And he came back, and his answer to McDonald's, and I'm sure he charged him a lot of money, and he should have, was, there's no way to tell. And what he meant was the number of assumptions you had to plug into your model and the variance associated with each of those assumptions left you in a position where you simply couldn't tell. My point is sort of twofold. One is that it's important to recognize that every part of this assessment is complicated and uncertain. And then the other, to come back to something I said before, which management is judgment. And judgment means you're making decisions based on incomplete information. And there's kind of no way around it. But that doesn't mean you don't do it. You just take the best shot you can, and then there are ways to deal with it, but I don't want us to think that it's easy to identify what the better practice is just because things are hard.
And do you have a closing soundbite for us, closing thoughts before we hear from Carol in terms of the take-home message?
Look, I guess I think of it from an investor's point of view rather than a public agency. Public agencies, if you ever want to have fun, take a look at large state pension funds and look at their governance. it's sort of the Upton Sinclair and the sausage making of finance. I guess in the end it's measurement. If I am looking at a fund, if I'm giving up diversification because they're green, I want to know how much, I want to back test it. And if you want to see how to do it right, the Norwegian State Fund does an extraordinarily careful job of looking at over time, what it costs them to take things out of their portfolio. And it costs them. But they're the sort of things that you'd take the cost in order to do. But in every case, you need to be able to measure. And if somebody here's a great idea for a project, right? You get hired by a large private equity fund. They want to do impact investing. Devise an incentive structure which in fact measures the impact side as well as the financial returns, and doesn't do it in a fashion which skews your investment decisions towards the kinds of ES elements which are easily measurable. Because the truth is, if they're easily measurable, it's much less likely they'll get taken care of another way. How can you do it in settings where it's really hard to measure it? And if you figure that one out, there are a lot of private equity firms who are going to be really happy to see that.
Thanks, Ron. Carol.
Yep. Great points. I would say that, in terms of the direction that we would like to see this headed, kind of what the holy grail is that this ESG integration at a high level really becomes embedded into the traditional investment management process, and that the need to kind of refer to it as something that's delineated and separate goes away, and that it entirely just becomes a part of the standard investment process. And so that's the reason why we work so much together with organizations, standard-setting organizations like the CFA Institute, as well as with the various business schools, Columbia, my alma mater, UPenn, Chicago, kind of the standard bearers in terms of what defines traditional investment practice, and that it becomes something that's no longer kind of a separate class. And I'll note that at all of the various top business schools, the sustainable investing classes, just anecdotally, happen to be the most sought after classes within the business school curriculum. It's incredible demand at the student level. So we're seeing that within the business schools, the eventual analysts and the portfolio managers, there's a really strong interest. But we would like it to get to the point where there no longer has to be a sustainable investing class, that this just becomes standard part of the corporate finance class, of the investment management class. And that's the world we'd eventually like to see.
Lovely. Well, please join me in thanking our panelists for a fantastic discussion. Kathleen, please close us out.
I'd also like to thank Lisa Sachs and her team at Columbia Center on Sustainable Investment for their collaboration, and I'd like to thank Ellen and Avian, who are my colleagues, for making sure.
Thanks. Thank you. Pleasure. Did you enjoy it?
Yeah.